We also have double bottom, and we also have a trend line liquidity like this, whereby price is actually creating a trend. That's what we learned when we started learning Forex. Yes, we say we have a trend line liquidity, one. We also have double bottom as a liquidity. We also have double top as a liquidity. Now, if you check the real life market, you see that these things are not actually playing out because you can actually see a zone whereby price have a double bottom and still something like this will happen. Something like this will happen. Instead of market to take out this double top, it will just mitigate on this area and start pushing down. So if you check it, you see these things often happen. So I would say that this method of identifying liquidity are just old method and they are no longer working in the market. Now, there are only three ways in which you can actually identify liquidities in the market. This is a modern liquidity, which is number one. We have transactional liquidity. Let me just write three of them down. We have transactional liquidity. We have transactional liquidity. We have transactional liquidity. We also have structural liquidity. We have a structural liquidity, and we also have what I call inducement liquidity. I will show everything, I will explain everything step by step. We have inducement liquidity. We have inducement liquidity. These are the three liquidities that actually place in the market. And I've actually backtested it and I see that these are the actually liquidity that we have in the market. Because in the forex market, what we actually do in the forex market is to buy and sell, which is it involves bid and ask. It involves the investors either buying or either selling. So now let me start from the transactional liquidity. Now, what is transactional liquidity? The transactional liquidity is a process whereby market creates, let's assume that we are going in an uptrend direction like this. This is an uptrend direction. And market is actually pushing in an uptrend direction. Now, if you look at this liquidity here, this higher highs here, this is a transactional liquidity. Because those areas, transactions are being made there, which is retailers are actually selling from that area. So you can see these are transactional liquidities. Those break of structures, these highs are transactional liquidity because there are people actually putting a sell movement here that actually sell that made this particular move to occur, this pullback to occur. And that's a transaction. There are actually transactions made there. People are actually selling these products from this area, this market from this area, making this to be a liquidity, which we call it a transactional liquidity. This is a transactional liquidity in the market. So, but the major direction of the market is what? Up direction. So, in a process whereby the market comes to take out this higher, which is the movement of the market, which is the uptrend, which is the bullish movement, comes to swipe these areas. This is called what? A transactional liquidity taken out because someone was actually selling this market from this area, putting a stop loss. So, in a process whereby market takes it out, it actually means that this is a what? Transactional liquidity. So that's the first liquidity we have in the market, which is transactional liquidity. So now after transactional liquidity, we also have the second liquidity, which I call the structural liquidity. Now, how do you identify structural liquidity? Now, for example, let me use my own strategy, which is everybody here, I believe you already know how I trade. So for me to identify a valid break of structure, I have to see something like this. whereby price takes out my inducement, then break this area, this transitional liquidity, which becomes my valid break of structure. So this is a valid break of structure in my area. So I have to see something like this: price taking out inducement, break a structure. Now, and price start creating this kind of movement, whereby we're actually waiting for our inducement normally. Now, all these things, all these movements here that price is actually creating, these movements here, these areas are all structural liquidities. All these things are liquidities, are all structural liquidities, because price are actually seeing, the market makers are actually seeing that these are stop loss, stop orders. So it have a high probability chance that price will come back and swipe all this liquidity, mitigate in this area, this protected low, and keep on buying. Now, all these things are what structural liquidities. So now, for me to, in my own system now, how I identify all these liquidities, if I want to put it in my own system to trade properly, is one. In my system, I consider the last pullback as my inducement. So this particular area now, this last pullback now is now my inducement, which means I will identify this area as my break of order block. This is my first POI, point of interest, and this is my last POI, which is the two POI I normally consider for me to take my entry. Which means if price comes back and take out this first area, which is my normal inducement, and mitigate here, I can actually buy from here, but it's a low probability area unless I see a confirmation entry. Price can actually move from here. That's my first confirmation. Then these two area 1, 2 are no longer important for me. I will only look for the last liquidity area whereby markets, like the last liquidity area, which is from here. This should be the last liquidity area for me. I will wait for price to come and take out this last liquidity like this for me to enter from this area. Now, let me explain more. Reason why price must actually take out this liquidity for me to consider this other block or to buy from this other block. One, this inducement here, that this structural liquidity here that occur here, which I call it, and normally I will call it structural liquidity. That's what I call it. SLK, structural liquidity. Why I call this first one inducement. I will still explain inducement. You guys also understand inducement. Now, the reason why I'm actually entering this trade here, one, is because there is a liquidity here. And because of this liquidity, it means that if market makers swipe this liquidity from this area, if market makers swipe this liquidity from this area and mitigate in this other block, then I have a high chance of buying from here because, one, this movement here swipe a liquidity, take out liquidity, making this low a valid or protected low. So from this area now, I have a high chance of buying from this place. I have a high chance of buying from this area here, putting my stop loss below here and pushing from this area. And also, I also have a high chance of buying from here because there is also a liquidity here that made this zone after inducement a valid liquidity. But this zone after inducement actually works well only on a lower time frame. This zone after inducement only works very, very well only on a lower time frame. But on a higher time frame, what you always be looking out for is this structural liquidity, which is this particular lowest one. That's where you'll be focusing more, which I will still get there when we get to pairs of markets, so that you can actually know when reason why market hits your stop loss, reason why market hits your break even, and reason why market is actually coming down to that point of interest that you're actually not looking at. So this particular section is very, very important. So whenever you want to identify this structural liquidity, it plays very well on higher time frame, and also it also helps you to what, identify a valued area whereby you should buy because of the inducement that actually, or let me say, because of this liquidity that actually occurred here, making it that the market structures or market makers will take out this liquidity and mitigate on this area and start buying. We'll explain more when we get to higher time frame. So now let's move down to the last one, which is inducement liquidity.
They said the other side now, that one maybe.
Now let's move to the inducement liquidity. Now on the inducement liquidity now, we already know that inducement is area whereby market makers takes out retailer traders from the market. Now, in a situation whereby you have something like this, market swipe this area first, then break this structure, break this structure like this. Break this structure, which is transitional liquidity. We call this a break of structure. And on breaking this structure, we consider this low to be a protected low. This low now to be a protected low because of this swipe, because of this particular movement, take out liquidity. So making this area to be a protected low like this. Let me just put this trend. Now, on this particular point of time, we are now waiting for inducement in the market to occur. We are waiting for price to create inducement for us, to create something like this and push up. Now, on a situation whereby we are waiting for market to create something like this, inducement. So for us to be able to take out this inducement, mitigate on this area and start buying. And unfortunately, price didn't create something like that. Rather, price did something like this. Push down from here and take out this area. Now, many of us will be confused in this inducement. Now, this is actually an inducement. This thing is actually an inducement. Price was unable to create, since price was unable to create an inducement for us, automatically we are going to use this low as our inducement. This low will become our inducement in the market. Now, know this is not a change of character. This low now is considered to be our inducement. I know many of us have actually been making this mistake. This is not a change of character. Rather, this is an inducement because market was unable to create any inducement there. So markets use this low as our inducement. So because of that, we are going to move down to lower time frame and look for something like this. Wait for market to create something like this for us. Once market creates something like this, now this is our entry to buy this market. This is from here now, we can actually buy this market from here. I know most of us are actually confused. Well, I'll still give room for question and answer. So this is actually what this market did. Because there was no inducement, market didn't create any inducement for us. Our normal inducement, whereby we need to see something like this. Market didn't create that. Rather, market came back and swiped this low in form of our inducement. Before now, if market do something like this, I will call it a change of character. But this is not a change of character. This is actually market using this low as an inducement. So since market didn't create an inducement, you have to wait for market to take out this liquidity because there was a transaction here. There was a transaction here. There must be a transaction. So since market have actually taken out this transaction, we wait for a confirmation. From there, we can actually buy. Now let's move to the real. I believe I've actually explained the three liquidity we have, which is transactional liquidity, structural liquidity, and inducement liquidity. So take note of these three liquidities I just mentioned now. So let's go to the real chart, to real market chart, and actually see more on these things. Let me clear everything. Let me use this gold. Gold, I entered gold today. Let me use gold. I entered this gold. So now on this gold now, the first thing I do for me to enter market now, because I already understand liquidity. Now, when we talk about liquidity, we're talking about top-down analysis. Now, before I normally focus more on lower time frame. All of them are actually okay, but I believe higher time frame gives me a clear things to see. Also to understand, to see where there is area of liquidities in the market. Now, the first one is this. The first thing I normally do is to go to 4 hours time frame. Now, on the 4 hours time frame, I will see everything I need to see. The current price action in the market. As you can see, these are the current price action in the market. This area now is the actually current price action in the market. This is my 4 hours time frame. So the first thing I do is to do normal thing I normally do, which is to look out for a valid break of structure. Now, on my valid break of structure, let's watch out. This is a trend, a movement that is actually showing that the price is actually going in an uptrend direction on the 4 hours time frame. So what do? I have to identify my what? Inducement, area of inducement, to identify a valid break of structure. So if you look at this area here, you see the price actually cleared inducement here. As you can see, price cleared inducement here. And for that, because of that inducement, I consider this high to be a valid break of structure when price came and take out this structural liquidity, as you can see. So this becomes my valid break of structure. So after identifying valid break of structure, automatically this low now becomes a protected low. Let me map it out. This low now becomes a protected low that if price comes back and take out this low in my 4 hours time frame, automatically it is now a liquidity, a change of character for me because I've already gotten a valid break of structure. So now currently now we're on 4 hours time frame. Now the next thing I have to look for is what my structural liquidity. Now, how do I identify my structural liquidity? The last, or let me say, the first pullback before the continuation of trend lines, pullback, that should be my structural liquidity. So let's look for where price actually creates a structural liquidity. This was the first market swipe this liquidity pushed up. Now, I'll consider this area to be the last pullback for me and look for any other block there that is actually close to that area. So let's check if there is any other block on 4 hours time frame. If you look well, you see that we have other block here. This area is area of other block. This is another block. This red candle here is another block. Because that red candle swiped this, I will still explain advanced order block so that we also understand because market is actually changing. But let me just explain let me just be taking it step by step. This area was the area of order block, and this was the last structural the last liquidity that formed, which I consider to be a structural liquidity. So once I identify these things on my 4 hours, now I can now go down to lower time frame because I'm a day trader. I can now go down to my 15 minutes, 5 minutes, and 3 minutes and start looking for entry. So the next thing I move down is let's go to 2 hours time frame. Now on the 2 hours time frame, from here now, you can actually see a change of character because price are actually mitigated on the higher time frame, which is 4 hours. I can consider this to be a change of character for me. This is a top-down analysis, identifying liquidities in their own forms. This is a change of character for me. And after identifying this change of character, then I will look for the area of inducement. The price pushed from here, create this thing. This should be an internal structure. Price pushed up again, create this area. And price use this as our inducement. Price swipe this area on gold. This is gold we're actually analyzing. So this should be my inducement. So price take out this inducement and use order flow in terms of buying. So this is order flow entry. As you can see, there was no other area for price to take out because everything here was internal structure. So price mitigated on this area after taking this inducement. And after taking this inducement, we also have another break of structure now. This is a break of structure on the 2 hours time frame. Now, after this break of structure, automatically on the 2 hours time frame, we now have a new protected low, which is this. Now, remember, we are trading based on, we are day traders, we are not swing traders. So we are going to still move down to lower time frame because I want to trade on this current price action. The reason why I entered that say on 5 minutes. So now, this is now inducement again. And after this inducement, price mitigated on this area now. The last area, which we use this as what? Our order block. And price mitigated here and start buying on the 2 hours time frame. Here, this is our new break of structure here. Then after this break of structure in the market, let me map it out, our break of structure. After this break of structure, we have the last structural liquidity. Now, this is the last structural liquidity here. That was the last buy. So I call it structural liquidity. And price actually take out that structural liquidity. And after that, we can actually buy below this, use this week as our entry. Now, this is based on gold. So now on the 2 hours time frame now, remember on the overall time frame, which is 4 hours, the price is actually going up. the market was actually going up. So we are expecting on the 4 hours time frame for price to come and take out this high. So we are still in overall of the market from the 4 hours time frame. We are still in an uptrend direction. So now we'll be expecting for price to what, keep pushing up. So we are still coming to that. You still understand the daily bias and everything. So now at this point of time, we are going to move down to 30 minutes time frame. We are going to move on 30 minutes time frame now. Now, because this is the current price action for today. So I'll move down to 30 minutes time frame. Now on 30 minutes time frame, this automatically becomes a change of character for me. This high. This high becomes a change of character for me. And after the change of character, remember, the reason why this high becomes a change of character because price have already taken out this liquidity, this low, making this area to become a protected low on 30 minutes. Remember, we're actually buying up. This is 4 hours telling us that the overall trend of the market for the week, for the month is actually going in up direction, as you can see. So now, on the 30 minutes, this becomes a change of character for me. And after this change of character, then I will map out the last inducement for my, which is structural liquidity. So now let's map out our structural liquidity, which is the last inducement. As you can see, price pushed up before. This was the first inducement. And after this first inducement, we have this to be our last inducement, which is this area. This should be my structural liquidity. So that's where I'm actually waiting for price to take out. If you don't know this thing, you enter here. If you enter this buy here, price we come and take out that low and keep buying. And you'll be like, why we've price hit my stop loss? So me, man, I'm anticipating for price to come and mitigate here. Mitigate any once price take out this area, I'll be expecting to buy from anywhere here. I'm expecting to buy gold from anywhere here. So now let's move down to 5 minutes, which is my entry point. If you go down to 5 minutes, you see that on 5 minutes time frame, price is actually showing us a downtrend because everything that is actually happening in the market is all about structure. So now on the 5 minutes time frame, if you look where you see that previously on the 5 minutes time frame, price was actually going up from here. Now let me map out the last break of structure on the 5 minutes time frame. Here was inducement on the 5 minutes time frame. This area was inducement on the 5 minutes time frame. We had a break of structure here. And this becomes the last change of character on the 5 minutes time frame. After this change of character, you see that everything is actually colliding. We had this inducement, this area. This was the first inducement. Price mitigated on this area. Now we are on a lower time frame. Remember, I told you that zone after inducement works well on the lower time frame. So price mitigated on this area, and now we were expected for price to break this structure, but something happened. This was a liquidity. Price didn't close with body. So from here now, we had this area to be our change of character. Sorry, this is not a change of character because price swipe this high. You're supposed to have a break of structure. So this inducement was transferred from here. We had a transfer of inducement, not a change of character. This inducement was transferred from here to here. So that's why I map this to be an inducement. Because of this inducement, I'll be expecting for price to come to the extreme zone here on the 5 minutes for me to start buying. If you check well now, you see that both 5 minutes and 30 minutes are actually saying the same thing. So now I'm waiting for this extreme zone to mitigate. So if price mitigate on this 30 minutes, I also wait for change of character on the 3 minutes time frame to start buying. So now the reason why I actually sell this gold here, the reason why I actually sell gold here is because price have already taken out this inducement. After taking this inducement, now we're expecting for it to come down to this extreme zone. I map this area. This should be an internal structure. But if you go down to lower time frame, like 3 minutes, you see it where this should be an inducement. And I actually mitigate this price mitigated on this zone after inducement here. That's why I sold from here. Network. Hey, so let am go back. What for be? There you go. There you go.